morning, you guys. So it's June 14th here, and we're just about 45 minutes into the New York trading session. And guess what? I had another sell signal on the euro, so I went ahead and put on a put option on the binary for the euro. So I'll go ahead and talk about this for a second, and then I'll go into some economic news that should be released tomorrow, and some sentiment in the markets, and my take on things. Okay, so we put a put option about right here. And the exercise price was, the strike price was 112. Yeah, 112.238. So 112.23 pips and a fraction. And of course, this seems like a perfect trade. It's nothing but negative price action ever since I opened the trade. Seems like a perfect trade. And then if you see the contract amount, so out of the $1,000 of the mock trading size, I put $500 or $499. So I mean, I was very confident. I'm very confident about this signal. Yet I'm not confident about some of the exogenous factors that could develop in today and this coming week. So I mean, it's kind of insane, but that's a good thing. So my idea is that there's going to be a positive surprise. So this always happens because this type of negativity is just sort of touchy-feely. That's going on in the markets, and the markets are showing contagious, I guess, behavior or symptoms without showing the real symptoms. So, for instance, for the euro and for the U.S. dollar to the Canadian, there's really tight spreads. So the currency spreads are very slim. So usually that means that markets are healthy, there's a lot of liquidity, so there's not a loss in liquidity. So if you were still buying, if you had a buy trade, you're still healthy. So this contagious behavior is really just kind of like, well, we got a little bit of a chill here, so now we're thinking, well, markets are going to go down, everything is alright. And of course, in the States, where I'm coming from, basically the domestic violence and domestic terrorism has reached an obscene level, unacceptable level, and so there's a lot of bad news. So I'll just go ahead and switch gears from that. So tomorrow is going to be at FOMC meeting, and a lot of people are saying it should be overlooked because it seems like we have already discounted what we believe is going to be the decision, which is like no decision. So what I want to say about this is basically the idea is that the Open Market Committee, the Federal Open Market Committee convenes, and they make a great show on how they want to telegraph for us, through their transparency, how we can just sort of profit or maybe be a part of the gang. I don't know what they're trying to do. So the idea is that that they're dovish, or that they're being dovish by keeping things even keel and not raising interest rates or what have you. But if you look at the balance sheet of the bank, so I mean the bank is holding what is essentially $1.7 trillion in mortgage-backed securities. And they've been outright buying securities in the form of treasuries. Usually what they would normally do in normal circumstances is buy U.S. treasuries, T-bonds, long-term treasury securities, and sell them. So they would buy them and sell them in the open market to make the market and to provide liquidity or to suck up liquidity if they wanted to raise interest rates. What they're doing now is, well, they were able to kind of buy a lot of agency debt, which is the Ginnie Mae, Fannie Mae, and Freddie Mac, and mortgage-backed securities, and to the tune of $1.7 trillion. So they're making markets for a different agency. They're not making markets for the U.S. government or for the well-being of the U.S. financial markets via stock market, bond market, etc., etc. They're making markets for what is essentially agency debt, which is Fannie Mae and Freddie Mac. I forget the nuances at this point, but most of these agencies, they're not government agencies, or if they are, they're still able to package and securitize non-government securities. So there's a very huge agency conflict going on, and so basically I won't get into that, but just for the sake of argument, Russia, India, China are stockpiling, on gold, whereas the U.S. is stockpiling on agency debt, as well as government securities. So that's a huge conflict of interest, and it's an interesting play, but it's not being talked about. And so there's just a lot of things that could arise from this that are problematic and not good for the currency holder of the US dollar. So I'll just leave it at that and switch gears here. Okay, so my final point that I would like to make is basically, as a trader, now is a good time to, if you have your risk management in place, like I said, because the markets are showing contagion, but they're still healthy. So now is the time to kind of be thinking about going for the kill. So if you're not expecting to make a lot of money, you're probably looking at the wrong market. You should be expecting to make a lot of money if you're not making a lot of money already. And so having the risk management in play is the most important thing, because markets are going to become turmoil, are going to have turmoil. And this volatility that we're experiencing, like for instance today, perhaps yesterday, is still just very basic. It's just very simple volatility. When we reach a turbulent level, then you're going to understand basically that, okay, so now we must obviously reapportion our trading our expected profit and our stop losses, and so understand that these bands are going to have to go wider. So everything else remaining equal, you should be making some more money. And like right now, I'm going to be going on 3 for 3 profitable trades. And so, well, this one I only put, I don't know if I noted this, but I put $500 on the trade, which, everything remaining equal, I should have put everything. I should have basically been 100% confident. But of course, that's not the case. So you have to look back and say to yourself, okay, so 3 out of 3 trades, how much did I make?